2025 EMI Report.
Hi, I know it's the afternoon. I myself feel a little bit down, so I can only imagine how it's a very heavy day. Every day, every year we say next year we have to have less speakers, but then we get so carried away with so many important subjects and so many important people who have become part of this conference. And yes, it's not easy for our minds to keep alert the whole day to so many very important panels. So very grateful to Corning and Siemens and so many colleagues who spoke in the previous panels. So for us at EMI, it's very important point is to launch the EMI report. We have here in the room many people who have participated in the EMI report. We have Soraya, who has participated in the past, Dimitrios, so many of you, Devesh Verma, who is here in the room, in not only that participate in helping us with the data, with the analysis of the data, and then we realized, oh my God, the data was downloaded from the wrong column. So, and then you realize and you have to redo all the graphs again. That's the problem when you manage so much data that we want to collect for the EMI report. So those in the room who have been part of the EMI report, please stand up and be recognized. Very, very grateful. The interns, the summer interns that did a lot of work every summer, not this last summer, but every summer. So very often in this report, we had to call the interns from 2 years ago, because the interns from 2 years ago is, okay, something is happening, the data is not matching from 2024 to 2025, it has to match. So the first thing I wanted to say also that from the very beginning, when I took over from the startup that of course co-directors Andrew and Yaru launched extremely well, and very, very grateful to all the work that you did, Nell and Bob Esteli, Rustam, so many alumni that got very enthusiastic, and Rob and Gail very, very soon got very enthusiastic. So when I took over, I thought 3 things. One, you need a little bit of critical mass, so critical mass of students who are with you, and also that will be the alumni of the program. Second, a voice. You have to say something. And Rob always reminds me, the chapters are too long, this has to change. The attention span it's true, the attention span of all of us has been reduced. So this is too long, no attention span, too many. So we still, and Anne, who was coming from the United Nations, from the World Investment Report, who has been the Bible for many of us in international business. So Anne said, no, this is fine. So we always discuss, we want to convert it in something shorter, more agile, that is going to be Cornell Emerging Markets Review. So there are branding issues and other issues and funding and this and that. So hopefully, and that's our intention, to collaborate with EMIC, the Emerging Markets Institute Club, to continue collaborating with all the partners that we are working, OECD Development Center, UNCTAD, IFC, and actually Denise Odaro, who will be speaking later on. Denise was instrumental to get IFC part of the EMI report. And so we don't only benefit from our discussions with the EMI Club, with the interns, with the colleagues, with the very important Emerging Multinationals Research Network, but also we benefit a lot from the discussions with the partner organizations. We present in their events, they present in our events, and that is a tremendous source of knowledge. And also from time to time, and consults with her former colleagues at the UN and say, oh my God, this data, something is happening. Please let us know if you think we are on the right path or not. So yes, the report has been enriched by these partnerships. of course, the most important one, Anne and I, who can fight like crazy, and we continue working together, which is a miracle. So definitely from this partnership is what both of us, I think, no?
Yeah.
We learned a lot from each other.
Not sure.
And then the third thing, so the voice, the institute, so the students, we are an academic organization. We have to have a student. And the third one is the outreach. So this is the most important outreach that we have, the EMI conference that we organize, again, with plenty of volunteers every year, where we launch the report. And then, of course, the Corning case competition, delighted to work with Claude and his team, and the working together has become deeper and deeper. As I said, they came to the presentation in July of the interns. We had the country manager of India, South Africa, and I believe UAE, plus Titin from Singapore. And then the Mark Mobius pitch competition, definitely. And also we create networks. Heather, who also, we will hear more about her later, VC fund in UAE, also talking to Mark. And so I think you create networks that are beneficial for everybody. So as I said, we are celebrating the 10th anniversary. Do we have the PowerPoint? Not yet. Okay. So 10, and then we started in 2023, a reflection. Is the first quarter of the new millennium, of the new century. Time to think what has happened in these 25 years. So the first cover of the report, and I was invited to speak in Panama by chance in the competitiveness commission of the government. I was invited to speak in the event. So the first report was something that we all praised. Costco, a ship from China, paid $5 million to be the first one to enter the enlarged Panama Canal in June 2016. So that year, that was the biggest infrastructure work in the world done by emerging market, okay, in collaboration with many companies, of course, from all over, but it was led by Panama, so Panamanians were feeling so proud, and it was a moment in which the China and Latin America, South and South, winning situation for everybody. Imagine this year that Panama, in a moment in which size matters, Panama as a country feels completely squeezed. Guess what? President Trump has said, we should recover the Panama Canal, a tremendous shock for Panamanians. And at the same time, first, Chinese companies negotiated selling to BlackRock and others in the US. And now the Chinese companies are saying, we are not selling anymore. So from 2016, when we launched the first report, that South-South harmony and creation of wealth, to this year, new rules, and we want to be always optimistic, new opportunities. We are in a new paradigm, so the change was quite radical. So in these years, what we have done, for a number of reasons, in fact, because both Anne and I had done a lot of work on companies from emerging markets, so we say we'll concentrate on that. Also, the World Investment Report does that, but we'll do more micro research. So collaborating with them from day one, also because Anne was coming from that world, so we had a very strong links. So then we decided that. And another thing we decided, to survive, we will not get into politics. That's impossible today. Everything is geopolitics, absolutely everything. So still, we are still surviving, still away from politics. Don't ask us any opinion. So also another thing we did was stock markets. Of course, I think I was looking at this recently. I think the US stock market is 60% of all stock markets in the world. So definitely other stock markets have grown, China, of course, India as well, and less other emerging markets. But we looked at revenues because there are so many companies that are not public in emerging markets, or they are different ownership, private, public, state-owned, public. So that's what we did. Then we organized, also we we were witness of the rise of companies from emerging markets, mainly, the elephant is in the room, mainly from China. So now you talk about many sectors, and you have Chinese companies competing head-on with US and European companies, with other rules, with other economic paradigms, and that's the reality, and that has changed. So from the harmony of 2016, that was the year that President Trump won the first term and started with a trade war, till 2025, in which this is, of course, much more controversial, absolutely everything. Okay, please, next one. So then in this one, the new rules and new opportunities, so we usually in April, May, we start a big discussion with all the stakeholders, the Advisory Council of EMI, Faculty Council, our colleagues at EMRN and others, which subject, which theme will encapsulate what is important for the next year. And this year we set new rules and new opportunities. And then we also look, and I'll talk in a minute about it. So let's go directly to the new rules and opportunities. So what has happened in the last 25 years of this millennium? As I said, we started this discussion in 2023, where we discussed that there were two models, market capitalism and state capitalism. Since then, we have seen the pull of governments having much more to say in the business sector, and this has increased for sure. We can see examples here in this country, the government taking 10% from Intel, the company, and of course the country telling companies, you have to invest in this country because this country wants to recover part of the manufacturing facility, manufacturing capability, and we heard a lot about that in the first panel today. So then, in the meanwhile, and in spite of all these changes, from peripheral, emerging markets are now central. Of course, China again, but also India. So India right now having a lot of pressure not to buy oil from Russia, but so far, India continues to buy oil from Russia and wants to be very close to this country, but still, as we heard also in previous panels, Latin America also feeling squeezed. The most important trade partner, China, and at the same time having all the pressure from the US that has been the traditional ally forever for the region. So how do you manage that? And we see that. Then, as I said, emerging markets central from peripheral to central. Emerging markets also catching up and also fixing the rules or trying to fix the rules. The rules have been fixed. Okay, I'm originally from Spain, so they say we innovate and Europe regulates. So Europe has been not only regulating, but imposing standards and regulations with the rest of the world. But now we see that more and more emerging markets, definitely China leading, but also India, Brazil, Indonesia, the big ones, saying, you know what, my rules are different, and I am there for my rules. And also we see all over the world, of course, it has been discussed a number of times, global value chains from efficient to resilient. So profits at any cost are being questioned all over the world. We believe also, and we started discussing this 2 years ago, that the Washington consensus, privatization, liberalization has been questioned, and also open the borders to trade that flows without any restrictions, that this phase is over. And as again has been said during today, tariffs were first in Liberation Day in April, were based basically only in which countries have the most deficit. And some of us, even us, my God, I didn't know that this country had such a huge deficit with Vietnam. So one of the countries with most the deficit. So then tariffs were imposed in those with highest deficit, but now has changed and using the tariffs as a way to influence politics that has been, of course, different. Then technology. First, the idea was that AI was going to increase the digital divide. Now these views have changed because, number one, you have in January this year, DeepSeek. DeepSeek is open source and is used and now everywhere. And now we have countries like India that has higher uses and higher implementation of AI in many different aspects, more than this country, which is amazing. So the fact to have open source LLMs has benefited the expansion of LLMs. And as Claude said in the previous panel, guess what? Now data centers can be vertical. So you need less land, and also there are ways to make them more efficient regarding energy. So AI that was initially thought as a way to increase the digital divide may not do so. And then again, was said before, new trade flows. We saw the chart that Joyce presented in the morning. So we see more global south investing. We see how China, and again, we saw the chart that she presented, that China immediately was able to reroute the exports that were going initially to the US and to China and to Europe, and are now more into the south. And then that way we believe that so far China has not been affected. And we saw one of the last issues of The Economist that was saying, who is winning the trade war? So initially was seen as that this country could impose and hurt China in many different ways, but since China has been preparing itself since 2016 with the first Trump administration, so then China is becoming more and more self-sufficient, and because the tremendous scale of the country, then being able to not producing some semiconductors, some chips, not the most advanced yet, but definitely going there. So then we see emerging markets going regional. We see this multipolarity in many different ways. As I said, not only China and US, but other regional players, definitely Brazil becoming quite a leader, or trying to, because it's not easy. And then also Indonesia, and in Africa, we see this Africa Trade Agreement that can consolidate the region and hope for the region. Yes, USA, as Caleb presented in the dinner last year, was completely cut, but maybe it's a moment that the region is looking inside, and we'll have later Osam from the African Finance Corporation who will say much more about it. And then EM's not followers anymore. They have to be followers in many things, but trying to find their own way and trying to find their own leadership. And now I'll pass the word to Anne.
I will have just a couple of figures to show you, but basically the message is that the foreign investment from emerging market has been a transformative phenomenon over the past quarter century. And the transformation is not only economic, but also geopolitical. And the bottom line is that now there are competitors from emerging markets that are challenging the position of the traditional contenders. And that explains actually a lot of what is happening, including now. Next. We'll go fast. Next. We focus every year. So an example or an illustration of this new power of the business from emerging market can be observed when we look at the large company. Every year we look at the Fortune Global 500s, but also we look at the number of billionaire company, that is companies that have won more than $1 billion in income. It's an estimation, okay? We use a number of databases, but more or less there is 10,000 billionaire firms in 2025. And the point is that they are clustered in a number of countries. First one, of course, is China and the United States. And you have the same figures, more or less, if you look at the Fortune Global 500. The only advantage of this work on the billionaire companies that we have launched as EMI is that it gives us a broader scope obviously because we have a sample of 10,000 companies compared to 500. And just here, it's just an illustration, and we have put in color the three big ones: China, the US, and Japan. And you see the huge discrepancy between the two leaders, China and the United States, and the rest of the world. China comes first. The emerging market phenomenon is definitely biased by the Chinese phenomenon. And that's why we have created a group which includes the E20 plus one, that is the emerging 20, if you want, plus China, because we don't know how to call China. Is it a developed countries? Is it an emerging economy? Definitely. Has it emerged, and in what sense? And that takes us back to the question raised by Lourdes. Next. We are, in addition to looking at the billionaires, we are also looking at the internationalization of a business from emerging market. We do that every year, but this year we took a particular look because we have been trying to take stock of what has been happening during these past 25 years. Let's go to the next one. It's just the next one. I just want to highlight, this, again, I'm focusing on emerging economies as foreign investors. We deal a little bit with emerging economy on the recipient hands, but we highlight that point nowadays. And again, China is one of the largest recipient of one of the largest investor in greenfield FDI. We are concentrating this year our analysis on greenfield FDI and merger and acquisition. I am zooming on the greenfield FDI for the sake of time. The interesting point as far as China is concerned is, again, it's a particular case because it's a net exporter of greenfield FDI, meaning it invests more abroad than it receives. And that's interesting because that's not the normal situation for an emerging or a developing economy, especially a country who has a GDP per capita of $13,000. So it's a middle income, but it's not really a rich country. That's an interesting point. Another element that we highlight again this year and that we began highlighting is that China used to invest in the region, around the region in developing and emerging economy. And then during the 2010s, there was a very big push towards a developed country, especially the Europe and the US. And again, it explains why we have this technology war, that's the way I call it, and trade war nowadays. Because of the constraints in the US and in Europe, there is a redirection of the Chinese investment, greenfield FDI, I'm not even mentioning merger and acquisition, towards emerging market. And the year 2023 is very interesting. In 2023, there was a huge increase of Chinese investment. As you can see, we went to from 60 billion to 120 billion. Basically, at least half of that was in emerging markets, between 50 and 60%. And zooming on automobile investment in North Africa, energy in North Africa, including renewables, chemicals again in North Africa, very, very interesting. Of course, I'm talking values in terms of number of these, the picture can be slightly different. We also highlight India because it's a rising actor. It's emerging as an important investor. So we think we have also to focus not only on China because of its special nature, but on other big emerging economy. So we have put India in this slide. And we want to highlight once again that Latin America, in spite of its very big economic size, is not a major outward investor. It's actually very, very modest, but it's a major recipient. That's a traditional situation of an emerging economy. Next. And now that point was mentioned this morning by Ms. Joyce Zhang. I mean, it's just to give you an indication. This morning, Mrs. Zhang indicated that there was an important amount of foreign investment flowing into the United States. And I like to mention that, I mean, just as a piece of, it's not an anecdote, it's really serious. What happened during the first semester of 2025 is actually the United States received, there was a very large amount of announced projects going into the United States, reaching $232 billion in 6 months. These are projects, but still it's twice, it's the same amount that was announced for the whole of 2024, meaning that if the trend continues, the amount of projects announced for the United States will be doubled in 2025. And what is also very interesting is that everybody was predicting, I mean, many experts and international organizations were predicting its havoc in the global environment, and FDI is going to fall. It's possible, but the figures up to now do not corroborate that assumption. And if the trend remains as it was, there will be at least as much this year as last year, and perhaps a little more. So that's quite important. And by the way, we are flagging the fact that out of the 232 billion announced for the United States, 40% come from the Taiwanese TSMC, another 20% from a Spanish one, and interestingly, data center from the UAE. So you end up with about 55% of the announced project coming from 3 countries. I'm raising this because what does it mean for the future? Is the trend going to continue? Big question mark. Does it mean that some policies are effective or not? Big question mark. We enter into geopolitics here because you have the UAE and the Taiwan. Next, and I think I will finish with that. And basically, one word. We are entering into another quarter of century, and we are entering it with a completely different landscape of the one that we had at the turn of the century. Meaning now you have in the world a group of countries that were, it's not that they were not existing, but they were not as powerful. So the next quarter of century is going to be, I would not say dominated, but heavily influenced by emerging markets. And I would say not only China, but definitely other countries in Asia. And I'll stop there.
Okay, we'll follow now the following order. Veneta will present their chapter. Again, tremendous collaboration with Universidad de los Andes from the very beginning. Then Andrea from OECD. And then last but not least, we have, I'm very grateful, Osam Al-Alaum, a Cornelian from African Finance Corporation, who has traveled all the way from Nigeria to be here with us and share the African perspective and the perspective from this multilateral. Veneta.
May I speak from the chair? Yes. Okay. I think my mic works, right? Okay. First, thank you one more year for our collaboration in Lourdes and for the opportunity to publish the outlook that we from Colombia and Universidad de los Andes can provide to the emerging markets. Problems and opportunities, and in this case, new rules, new opportunities framework that you propose. So I'd like first to say that the work I'm going very briefly to describe is a collaborative project with 2 colleagues of mine, for my colleagues Juana García over there, and also Juan Sebastián Trujillo, who is currently a student in London School of Economics in data science. And I'd like to hope that I will say something that, as our previous speakers were mentioning, ChatGPT will not immediately inform you about. I will talk about defense spending and the role that it has for emerging economies. And hopefully I will be able to engage in this conversation, which Anne and Lourdes invited us to be part of. And it is about how we define an emerging economy. Because for every session that we had today, we actually talked about value creation. But me as a strategy professor, I know that you win in a competitive game either through value creation or through your ability to destroy the value of others. And therefore, we probably need to look at not only the opportunities of emerging economies to create value, but also to be disruptive in terms of the ways some rules work and let's say some alliances are functioning. And this is the perspective we are taking in our chapter. So what do? We actually look at 4 different alliances, which have been, I would say, well established as alliances that have economic but also kind of ideological and defense elements to them. And these are the G7, the EU, BRICS Plus, and probably some of the data that I will share that is most interesting here for this conversation is the Shanghai Cooperation Organization, which is probably the least known, but I would claim probably the most interesting for the purposes of our kind of framework of analysis. In this framework, what we looked at is publicly available data. On first, innovation. So we looked at the data of the Global Innovation Index in terms of their innovation inputs and outputs and their innovation ranking of each one of the countries within those 4 alliances. And we also took data, which of course is very coarse. You know, defense industry is surrounded by quite a lot of secrecy. So we don't see the patents actually being publicly published. But in any ways, we were able to use the data from the Stockholm Institute for Peace Research. And we had data on arms imports, exports, defense spending. And we tried to see with, let's say, relatively smart econometric techniques, what would be the relationship between innovation and all these kind of defense-related data between 2011 and 2024. So our very short chapter within this report actually is 10 pages about the results. I'll just highlight a few of them so that we would like to invite you, Lourdes told me to say that, okay, to read the report. Please do read the report, download the report. So I'm kind of giving you just a sneak peek, just 3 ideas.
Good. You get the point.
I'm doing the job. Okay. So just a sneak peek. I'd like to share some of probably 3 ideas with you, which I think are relevant or can give us food for thought. And the first one, and again, I'd like to talk about Shanghai Cooperation Organization, which I think is the most significant one in terms of our data outcomes. What we found there is a very strong and positive causal relation between defense spending and innovation, unlike the others. And what we think is going on, and of course, we have been trying to look at evidence, case studies, and literature, but I just want to remind you who the countries that form part of the Shanghai Cooperation Organization are, and then I'll give you an explanation of why we think it's happening. So Shanghai Cooperation Organization comprises of China, India, Iran, Russia, Kazakhstan, Kyrgyzstan, Pakistan, Tajikistan, Uzbekistan, and Belarus. These are the countries that came together in 2001 and who apparently built a rather interesting virtuous cycle in double purpose technology. So that we can see a causal relation between their defense spending and their innovation outcome, because these are not the countries that we'll normally see kind of with very big jumps in global innovation index. We see this relationship for those cluster of countries. The other kind of result I'd like to mention here, which I think is important as a food for thought, is that for these type of results we don't see for G7 or for the EU. And even though we see a very important and positive correlation for European Union countries in that they're very kind of good institutional setup. The control of corruption actually is conducive of higher investment in innovation. We see that. So there is a certain clear institutional soundness within them. Their defense spending actually is not helping to start a positive innovative loop. And what is, I would say, probably an element that shall make us a bit more cautious about defense spending is that the more defense spending there, the higher perception of corruption.
Thank you, Veneta.
Thank you very much. I hope you'll read the paper.
Andrea?
Thank you very much. And I was not given any instructions regarding what to say, but I strongly recommend to read, download and read my paper as well, my chapter. And let me thank Anna and Lourdes for this invitation, which is very, very welcome. And I have 6 minutes, so I have 6 points in a very French Cartesian way of reasoning.
Good.
So the first point I want to make is about Indonesia in general. Indonesia is one of the best kept secrets in terms of emerging economies, but in general in the global economy, in the sense that it's certainly a country that punches well below its weight in the global economy. It's the largest Muslim economy and largest Muslim country. It's the largest country in Southeast Asia, which is a region that, as was mentioned, is growing very fast and which has very interesting institutional frameworks. It's a country that has gone through a double transition, a political transition and economic transition over the past 25 years. It was a basket case in the late 90s of corruption and bad economic management, and now it has certainly climbed the ladder, and it's well managed and certainly less corrupt than it was. So, and despite this, and also has a strategic role in the transition to energy security, because it's one of the countries with the largest reserves of a number of minerals that are important for the. Can you hear me? No.
No.
Do I have to do anything now? Maybe. Can you hear me now? Okay. Yeah, maybe because it's too low. Okay, maybe I hold this. What about now? Much better. Am I like Mick Jagger? Yeah. And so and it's also an important country in the strategic transition toward energy security. And despite this, it is certainly kind of a shy country in the global arena compared to others that do everything to propose themselves and to publicize themselves. Second point is, which is a reflection of this, is that in terms of a number of indicators of globalization, which are summarized by the globalization indicator of the EHZ in Zurich, it's a country with a very low degree of internationalization. And this is reflected in the inward FDI and a fortiori in outward FDI flows and stock, which are very low. So it's a country which has, for a number of historical reasons, is even more less integrated into the global economy than other large continental size economies and countries. The third point is that the data is patchy. So it's very difficult to come to a real analysis of what is happening because the data is patchy. We know that there is a very high degree of regional integration in ASEAN compared to what President Duque said before, compared to, for instance, Latin America. But we don't know too much about where the Indonesian firms the few Indonesian firms that have become international, multinational are investing. We know from anecdotes that it's mostly in the region, but we know relatively little. This is in terms of the stock and the flow data. In terms of activity data of multinationals, we have even less evidence. Against all odds, and despite all that I've said, that there are a number of Indonesian multinationals. Hardly companies that you know, because there are no global names, global brands from Indonesia, but there are a number of firms that have gone through a process of a relatively rapid internationalization. Let me just summarize two cases which are exemplary of the structure of the Indonesian economy, which is dominated by three typologies of firms: the state-owned enterprises, which play a very important role in the economy of Indonesia, with a relatively little in terms of privatization over the past 20 years; the conglomerates, which are characteristic of all emerging economies, which are diversified, with 1 minute, and and the third example, possibly the most interesting one, are the up and coming venture capital based pocket multinationals in the digital arena. So let me give you some names in the minute I have. Pertamina is the national oil company which has invested in Algeria in particular and in Iraq, but also in France. It has acquired an independent producer in France. And the other company which is interesting is Indofood, which is one of the largest producers of instant noodles. And as you know, there is a very large appetite for instant noodles in Asia. It's a sector like many others that is going through a process of consolidation, and Indus Food is one of the companies that is playing a major role. So let me finish with 2 points in terms of what this is interesting, why this is interesting in terms of the analysis. And I think it's interesting because it shows the role of, again, corruption and what was referred to before as the destruction of competitors' value as a strategy to become more successful. And in a country with a relatively little degree of competition in many markets, with a pretty high level of corruption that is playing out. And the very last point is what government should do. And I think the first point is to acknowledge the role of corporate internationalization as a source of strategic competitive advantage for the country, and not as a way to reduce jobs in Indonesia. And from this point of view, of course, a process of smart liberalization, which puts a lot of weight on institutional strengthening, is, in my view, and from my point of view, the most important thing that the government can do to nourish Indonesian multinationals. Six minutes is short.
Okay. Afternoon, colleagues, partners, friends. My name is Osam Iyahen. I'm a senior director and head of infrastructure at the Africa Finance Corporation, headquartered in Lagos, Nigeria. The pleasure to be here at the EMI annual conference, discussing what I believe is one of the most relevant themes of our time: new rules, new opportunities. This gathering comes at a defining moment for Africa. It's a moment when we are not just adapting to global change, but shaping our own rules for growth, investment, and development. The question is how we turn these shifting rules into real opportunities for inclusive and sustainable growth. This is exactly what drives our work at the Africa Finance Corporation. Our focus is to accelerate Africa's industrialization and create value on the continent, not by following the old playbook, but by developing new models of financing that brings projects from idea to impact. Our vision is to become Africa's leading infrastructure solutions provider. Our mission is to foster economic growth and industrial development across the continent while ensuring competitive returns for our shareholders. The global economic map is being redrawn, and Africa is at the center. The new rules call for emerging economies to own their growth, moving from raw material exporters to value creators, with manufacturing, processing, and innovation happening closer to home. I think it's the third slide. Oh, the next one.
Next one.
Yeah. Yeah. Sorry, it's the previous one. Yes. No, there's no clicker. Okay, probably yes. Ah, there we go. Okay. The global economic map is being redrawn and Africa is at the center. The new rules call for emerging economies to own their own growth, moving from raw material exporters to value creators, from manufacturing, processing, and innovation happening closer to home. So for Africa, this means moving from extraction to transformation, turning raw materials into finished goods, ideas into industries, and infrastructure into growth corridors. So to get there, there are three things that I'm proposing that we need to change, at least for Africa. First, we must lead its own development agenda. We can't just wait for projects to come to us. We have to originate, structure, and drive them ourselves. The best growth ideas are coming from Africa, indeed. We've seen that in the work we do. Second, we need to rethink how we finance development. So the old divide between public and private capital no longer works. The future is blending. public, private, and development finance working together to make complex projects bankable and sustainable. And the third idea is that we need to shift the perception of African risk. The data is very clear. Africa performs. Performance, not perception, should drive value. So, infrastructure as the catalyst for everything I've just talked about. We see infrastructure as a tool to create real impact. Every project should be proof that African development can be commercially viable, sustainable, and transformative. Over the last decade, we have invested over 16 billion across energy, transport, digital, and industrial infrastructure, catalyzing over $50 billion in total economic value. That's more than numbers on the page, it's real impact. It's 7 million jobs created, 6 billion mobilized from global investors, and nearly 9 million tons of CO2 emissions avoided each year. Today, we operate in 46 African countries with over 200 deals across 36 nations. Our projects drive industrialization, open markets, deepens regional trade, and lay the foundation for manufacturing and value addition across the continent. So when we talk about new rules, new opportunities, this is what it looks like in action. African-led, impact-driven infrastructure that is building industries, not just assets. So when you look across emerging markets, one thing is clear. Sustainable, inclusive growth depends on the right infrastructure. Infrastructure that connects farmers to markets, miners to processors, manufacturers to ports, and young innovators to opportunity. It's the backbone of inclusive development. So let me share a few examples that show what this really looks like in practice. Take Infinity Power, an AFC invested company, which is Africa's largest renewable energy platform, which is powering over 1.2 million homes. It's proven that clean energy can also be commercially viable, driving productivity and unlocking new industries. Then there's the Mahati infrastructure, which we built in East Africa, a logistics solution that has helped replace nearly 100,000 truck trips annually by transporting petroleum products through Lake Victoria. It's safer, faster, cleaner, and prove that infrastructure innovation can reduce costs while cutting emission. In the DRC, the Kamoa-Kakula copper mine, one of the most efficient in the world, now contributes nearly 66% of the country's GDP and 20% of the national export. That's infrastructure enabling industrial scale value creation. And in Guinea, our dynamic mining has created 1,700 jobs and created significant tax revenues for the government. And through projects like our Lobito corridor and the Kano-Maradi rail, we're also helping to reshape Africa's trade routes by connecting landlocked regions to global markets and driving industrial clusters across the way. So each of these projects tells the same story, linking infrastructure, industrialization, and innovation, and demonstrates that when infrastructure is done right, it doesn't just build assets, it builds industries, it builds capacity, and it builds confidence in Africa's ability to lead its own way. So the last slide I have here is just talking about the myth of debunking the African risk fallacy. This is a topic that always comes up when we talk about emerging markets. When we talk about emerging markets, it's called risk. But in Africa's case, that's often labeled as risk. It's really just unfamiliarity. The numbers tell a completely different story, as I mentioned earlier. Africa's project loan default rate is about 1.7%, which is one of the lowest anywhere in the world. Yet investors continue to ask for the close to about 10% yield on African bonds, among the highest globally. That gap between performance and perception costs the continent nearly $75 billion every year. This isn't about risk, it's about an outdated narrative. Too often the conversation ignores Africa's economic diversification, the strength of its financial institutions, and solid record of repayment and delivery. If we can close the perception gap, we can redirect those billions into real assets, factories, transport networks, power projects, and digital systems. That's where institutions like AFC and EMI come in. Our role is to keep proving with evidence and results that Africa delivers, that investments in Africa are competitive, consistent, and resilient. So the new rules of global investment should be built on performance, not perception. And when you look closely at Africa's record, the opportunity speaks for itself. In closing, as we reflect on the new rules, shaping global trades, one thing is clear. Africa isn't waiting for change. It's helping define it, thanks to its vibrant population of over 1.4 billion people, more than 70% under the age of 30. The demographic energy is one of the continent's greatest advantage, a generation that is entrepreneurial, tech-savvy, and ready to build the future. The new rules of the global economy will favor those who build resilience, embrace innovation, and lead with purpose. Africa is already doing that. The future of global growth is being written right now, and Africa is holding the pen. Thank you, everyone.
Thank you all. I would ask Carmen and Ariaman to come to the floor. Thank you very much. As Veneta said, please more online. We have launched the draft report, and the final report will be launched in a webinar at the end of January. Thank you, all of you who have contributed, and looking forward to continuing the research. Thank you.
Also, thank you.